It's been a long night reading the federal government's budget, and there's a lot of interesting things that I want to share with you. They call it a budget to ease cost of living pressure, and it's on that front, they've been very restrained in their expenditure, owing to the fact that they're trying to avoid increasing inflation. Now, at the start of the budget, they go through the fiscal outlook, and some key headlines here. They're forecasting inflation to peak at around 7% before dropping down to 4.5% in the next couple of years. They're forecasting unemployment to increase from around 3.5% where it is now, up to about 4.5% by mid-2024. That's still a very, very low unemployment rate and well below the 10 and even 20-year average. They're also forecasting that wage growth for an hourly rate basis will peak at around 6% in the next 2 years, although on the wage price index they're forecasting a more constrained 3 and a bit percent. Obviously the difference there between hourly rates and wage price index is in terms of the composition, but very, very strong reading on an hourly rate basis, which is obviously great from improving affordability. Now, when we actually get down to the expenditure, their key headline offers, first of all, they're increasing expenditure on childcare, so providing more childcare subsidies, reducing the cost of childcare. That's intended to get more people into the workforce. There's huge job vacancies right now, and they're obviously increasing the number of placements for people to move into Australia from overseas, so net overseas migration has been lifting, but they also want to increase the participation rate by helping to get mums into the workforce, and even some dads who are sharing some of the child caring duties. So they want to get more people into the workforce, which is going to improve the economy overall, as well as improving people's affordability. They're also looking at the NDIS. Cost of the NDIS is going to balloon in the coming years from around $29 billion up to around $50 billion in the next 4 years. That's a huge outlay on the NDIS, and that's obviously going to have a huge impact and implications on the budget in the future, but particularly for people who are looking to grow their wealth and save for retirement. It's important to understand that there's going to be a lot of pressure on taxes in the future, and Jim Chalmers has already noted that there's likely to be changes to tax in the future. So that's something to really be mindful of when you're making investment decisions as well, trying to use your tax as effectively as you can. Now, the really big thing that they've talked about is building 1 million homes in 5 years. So trying to improve affordability. And I have to tell you, this is all smoke and mirrors. Their investment in housing is actually dropping by 20% from 2020-2021 year down to the 2024 financial year. It's dropping by 20%. What they're talking about in building 1 million houses, they want the private industry to build 1 million houses. Now that would be the equivalent of building the same number of houses each year as the 3 years before COVID hit, which was hitting around 180 to 200,000 homes a year. So they really want to lift industry's production of housing to that level. They don't expect it to start in the next 2 years. They've pretty much waved that off and said, we know that there's not going to be a single extra house that gets built in the next 2 years. So they're talking about some promise of, in the future, increasing the number of houses. Now, this is something we've talked about quite a lot. In fact, in our most recent webinar, we also look at this, because changing the number of houses getting produced is actually quite difficult. To increase the production of houses, they actually need to rezone land. They need to advertise rezoning to the public to get them to have a say on the changes in zoning. They need to gazette that. They need to negotiate with landowners over who's paying for infrastructure. Then developers need to buy the sites. They need to go through planning and detailed design. Then they need to build their developments. And if that's a housing estate, that can take 10, 20 years to deliver houses over the course of a project. If it's apartments, it takes at least 3 years to build one apartment building, including the time to pre-sell and settle. So if they started today, there wouldn't be a single extra home on the market in the next 4 to 5 years. So again, we need to look through this. It's a veiled, it's a promise that has no means of them ever delivering. It's always been the case that state, federal and local governments are supposed to work together to coordinate their zoning, but they all work in different ways because of politics. Local government wants to get voted in. They really cater to the NIMBYs, people who don't want development in their backyard. State government also wants to get voted in, so they're looking for places where they're going to get the most votes, and then obviously federal government wants to get voted in. It's very easy for federal government to say we want 1 million houses to be built, and then it's obviously a lot more difficult to encourage state and federal governments to get on the same page, to overcome their own fear of being voted out by their local constituents, and to be on the same page as the development industry and the financing industry. So we don't take too much out of this. It would be lovely if they could do it because there's a massive housing crisis. That's why it's their big headline. There's a huge undersupply of housing with vacancy rates under 1% in Australia, and that's not going to change in a hurry because the forecast number of houses that are going to be complete in the next few years actually drops to 120,000 in 2023 in the forecasting. So dropping from 180 to 200,000 pre-COVID down to 120,000. So that's going to exacerbate the problem when we're also seeing growing net overseas migration. So our population growth is picking up and our housing supply is dropping. What does that mean? Rents are going to continue to climb. So lovely to say that we're going to address housing affordability. The reality is people are going to be paying a lot more rent in the next couple of years, and we're already seeing that start to push people into the first home buyer market, and we're starting to see an upswing in the number of loan commitments to first home buyers. That's the start of this bottom-up cycle. We've talked about this a lot. If you want more information, obviously reach out to the team. We can provide some more insights about what the bottom-up market cycle means and how to take advantage of that.